Hello everyone, and welcome to Virginia International University's MBA 603 Contemporary Issues in Accounting course. During this session, we're going to be talking about business combinations. As you may have understood from other classes, that as an economy contracts, the opportunity to grow is substantially reduced for many organizations, and so the business combinations, business mergers, and business acquisitions tend to be reduced in the quantity, both the number of transactions and the value of those transactions. As we see most recently, during 2014, the expanding economies around the world, with some pockets where they're still not expanding, but expanding economies around the world have really set the place for an increase in the combinations, mergers, and acquisitions. And so we want to talk a little bit during these first couple of chapters about how do we account for those activities. And so what we'll do is to talk a little bit about, well, why do business combinations or M&A, mergers and activities happen? We'll learn about the different forms of business combinations from a legal and accounting perspectives. We'll introduce the concepts of accounting for business activities, emphasizing the acquisition method. We'll see how firms record fair values of assets and liabilities in an acquisition and how that gets to this idea of goodwill. And so let's talk just a little bit about the economic motivations for business combinations and M&A activities. Essentially, business combinations unite previously separate business entities. And so we have Company 1 and Company 2. As a result of the business combinations, we may have Company 1, which incorporates Company 2, or we may have Company 3 left over. And depending on the legal structure of the activity will depend on whether there's a remaining company that previously existed or a brand new company. We have the idea of horizontal integration, where firms of in the same market and with the same characteristics merge, or one acquires the other. And an example of that would be ExxonMobil, where Exxon bought Mobil to make that combined company ExxonMobil. Then there's this idea of vertical integration, and that's where there are operations in different but successive stages of production or distribution, or both. And an example of this might be an apparel maker buying retail outlets in which it can offer its products to the market for sale. So we have the manufacturer also owning the retail distribution operation. And then we have this idea of a conglomeration, where there may be mergers and acquisitions happening between completely unrelated product lines. And there are some very large conglomerations out there. And there's been a lot of research and study around how these work, since in a lot of cases they don't work. But the thought is there that, well, so I'm a conglomerate and I own food producing companies, and I own oil producing companies, and I own manufacturing, apparel manufacturers. There's just no general theme throughout all of the different organizations that I own as a part of my conglomerate. And we can talk and look here at the reasons for combinations. Obviously, cost advantage is one, lower risk. So, for instance, perhaps I'm the manufacturer of a product and I want to buy one of my raw material providers. That's this idea of vertical integration. I've lowered the risk with respect to my raw material by owning that source. Fewer operating delays, avoidance of takeovers. Perhaps I'm threatened as an organization, I'm threatened by another company, and the fact that they may be interested in buying my company, and in response to that, then I buy their company. Acquisition of intangible assets. Those are items like patents, or generally we're talking about patents, to where perhaps I want to get a patent or a copyright to something specific, and so rather than wait for it to expire, I just buy the company that has it or that owns it. And then there are other business reasons, such as tax advantages or just personal reasons, where a particular organization's leadership may want to be in a specific market. And of course, nothing's easy. It's not always as clear cut as we expect. So we have to worry about issues like antitrust, and to where we do not, through acquisitions and merger activities or combination activities, we don't create monopolies that threaten the marketplace, which sometimes require that we have federal government approval of merger or acquisition or combination. And these involve regulations we see here that are issued by the Federal Reserve Board, particularly when we get into the banking industry, where we see a lot of, or have seen historically, a lot of merger and acquisition activities. Department of Transportation, Department of Energy, Federal Communications. Again, these are all regulations aimed at essentially protecting the consumers from the creation of monopolies or oligopolies, which I'm sure you've studied the characteristics of those dynamics in other classes. So now let's move into the different forms of business combinations. As we said earlier, we could be talking about a merger, and that's where one corporation takes over all of the operations of another business entity, and the other business entity is dissolved. So that is to say, Company A buys Company B, and Company B is dissolved, and everything is merged into and now operates moving forward as Company A. Then we talk about a consolidation where two companies essentially consolidate into a new corporation, and so that neither of the two previously existing entities remains after the consolidation. And this is just an example of that. So Company A acquires the net assets of Company B for perhaps cash, other assets, or Company A debt or equity securities. Company B is then dissolved, and so Company A survives with Company B's assets and liabilities. Another example would be as if Company X acquired the stock of Company Y from its shareholders for cash, other assets, or Company X debt or equity securities, and Company X is dissolved. And the difference between those two is that Company A is acquiring the assets, net assets, cash, and other assets from Company B, the management of Company B, where in the example with X, Company X is acquiring the stock of Company Y from shareholders, and that may be against the wishes of the management of Company Y. And so you can have an asset purchase where Company A is simply buying all of Company B from Company B, or Company X is buying the stock of all of the Company Y from the shareholders of Y, which essentially gives it control over the assets, cash and other assets of Company Y, and then they simply merge those assets with Company X and dissolve Company Y. And then we have this idea of a consolidation where we have Company D, which is formed, and it acquires the net assets of E and F by issuing D stock. So E and F are dissolved. Company D survives with the assets and the liabilities of both dissolved firms. And so we have a new company that is created, and it issues stock as related to this new company, and then the proceeds from the issuance of that stock are used to buy companies E and F, which no longer exist after the consolidation. Or we have an example where Company J is formed and acquires the stocks of Company K and L from their respective shareholders by issuing Company J stock. So K and L are then resolved, and Company J is left over with the assets and liabilities of both firms. And so the consolidations, the examples are similar. It's just that you start off from the point of a new company that issues shares of stock and then uses the proceeds to either buy the net assets from two previously existing companies and then later dissolves those companies, or buys the shares of stock to get control of the assets of two previously existing companies, which are dissolved after the consolidation. So I hope that helps in kind of understanding this idea of the different types of merger and acquisition activities. And so here we just say that it's important to keep our terms straight, so that mergers and consolidations are business combinations and may or may not involve the dissolution of the acquired firms. So in Chapter 1, mergers and consolidations will involve only 100% acquisitions with dissolution of the acquired firms. These assumptions we'll talk about in later chapters. And then there's this idea of consolidation, which is also an accounting term used to describe the process of preparing consolidated financial statements for a parent and its subsidiary. So just be careful when we talk about a consolidation. Are we talking about the activity related to creating a new company, or are we talking about the accounting process and accounting activities related to generating the financial statements of parent subsidiary companies? And so if we look at the financial accounting standards, we see that a business combination is defined as a transaction or other event in which an acquirer obtains control of one or more businesses. They are sometimes referred to as true mergers or mergers of equals, and these are both also examples of business combinations. And then we talk about this idea of parent-subsidiary relationships, which are formed when less than 100% of a firm is acquired or the acquired firm is not dissolved. And so what we have left over after those transactions is this idea that there's a parent corporation that owns could own 100% of a firm that is not dissolved. So Company A owns Company B, but Company B still continues in existence, and so Company A is the parent corporation of subsidiary Company B, or it could be that Company B is bought, but not 100% of the assets are acquired, so that there's some minority interest remaining. And so then we talk about, well, how do we account for business combinations under generally accepted accounting principles? And one way that has traditionally been done has been this pooling of interest calculation. Now, this method is no longer an acceptable method, and some of the primary reasons cited that pooling provides less relevant information to statement users. It ignores economic value exchanged in the transactions and thus makes subsequent performance evaluation impossible. And also, with pooling, comparing firms using the alternative methods is difficult for investors. It creates these problems because it uses historical book values to record combinations rather than recognizing fair values of net assets at the transaction date. Generally accepted accounting principles, or GAAP, require recording asset acquisitions at fair values. And as we discussed under international accounting, or the IFARs, most major economies prohibit the use of the pooling method. So these international accounting standards for it specifically require the international accounting standards for it specifically prohibits the pooling method and requires the acquisition method. So under this method, our reporting guidelines say that we record assets acquired and liabilities assumed using the fair value principle. If equity securities are issued by the acquirer, we charge the registration and issue costs against the fair values of the securities issued, which usually results in a reduction to additional paid-in capital. And then we charge other combination costs, that is, those types of expenses related to legal fees or finder fees, and indirect combination costs such as management salaries that we incur throughout the process to expense in the current period. Further, when the acquiring firm transfers its assets other than cash as part of the combination, any gain or loss on the disposal of these assets are recorded in current income. The excess of cash, other assets, debt, and equity securities transferred over the fair value of the net assets acquired is recorded as goodwill. And so, for instance, if we paid $10 million for these cash, other assets, debt, and equity securities, and they ended up having a fair value of $11 million, we would have $1 million worth of goodwill that we would recognize. And we'll talk about how we account for goodwill later on. And then finally, if the net assets acquired exceed the cash, other assets, debt, and equity securities transferred, a gain on the bargain purchase is recorded in current income. And so that's the flip of what we just talked about, where if we had paid $10 million for we paid $9 million for cash, other assets, debt, and equity securities, and the assets were really worth $10 million, we would have a bargain purchase option. That is, we paid less than what they were really worth, their fair value, and so we record that as a gain in the current income. And this gives us an example of that. So Pop Corporation issued 200,000 shares of its $10 par value common stock for Sun Corporation. Pop's stock is valued at $16 per share, and so when we record that, we record it as a debit in Sun Corporation, which is an increase in asset of 3,200, which is the 200,000 shares at the $16 per share value price. We record the common stock as an increase in stockholders' equity at the 200,000 shares times the $10 par value, and then we record the additional paid in capital as the difference between the two, which is also an increase in the stockholders' equity section of 1,200. So another example would be Pop pays cash for $160,000 in finders and consulting fees and $80,000 to register and issue its common stock. And these are in thousands. And so, as we discussed on our earlier slide, the way we would record that is that we would record $160,000 to investment expense. We would record the $80,000 as a debit to additional paid in capital, which is the reduction in our stockholders' equity, where investment expense is really an expense or a reduction to income in the current period. And we paid, as the example notes, we paid cash for this, so we would credit cash, which is a reduction in our assets. And under this scenario, Sun is assumed to have been dissolved, so Pop Corporation allocates the investment cost to the fair value of the identifiable assets acquired and liabilities assumed. Any excess cost over which the fair value of these assets are would be treated as goodwill. And this just simply shows that when we buy Sun Corporation, what Pop Corporation would do would be to increase assets for receivables, increase assets for inventory, increase plant assets. We would then increase accounts payable, which are liabilities. With credits, we would increase notes payable to the extent those liabilities were assumed, and we would increase our investment in Suncorp, and the difference between those entries then becomes a debit to goodwill, which is an increase in assets. So now let's talk a little about recording fair values in an acquisition, and how do we get to those fair values? What is that process? Because as we know, when we buy a company, we have that company's balance sheet and income statement. Those, as we know from accounting classes, are all based on historical information. And we know that under the acquisition method of recording our merger or acquisition or combination, that we have to use the acquisition method. So let's talk about how we go through that process now. So first we need to identify what were the tangible assets required. What are the accounts receivable? What are the hard assets that we're buying? Plant, property, equipment, inventories. What are the intangible assets we're acquiring? What are the copyrights or the patents that we're buying? And then what are the liabilities we're assuming? Once we've, as a part of that identification, we need to include intangible, identifiable intangibles that result from legal or contractual rights or separable from the entity. We need to think about research and development in process, contractual contingencies, and some non-contractual contingencies. So we just want to make sure that we have a good listing of all of those acquisition items, assets and liabilities, so that then we're able to move forward with identifying fair values associated with each of those. So we assign the fair values to the assets, and we determine these fair values by using different methods or metrics. And the GAAP tells us that these different methods or methodologies are used in the following order, preferential order. We use first established market prices. If we don't have those, we use the present value of estimated future cash flows discounted based on an observable measure, such as prime interest rates. And I'm sure in other classes you've talked about this idea of present value, future value. And so again, we see this continuing theme in finance of the importance of understanding time value of money concepts. If we aren't able to get to either one of those, we have to come up with some other internally derived estimations. And these are sometimes difficult determinations to make, and they involve the use of outside consultants that we end up paying a lot of money to. Now, there are some exceptions to the fair value rules, and there we would use normal guidance to determine the fair value of deferred tax assets and liabilities, pensions and other benefits, or operating and capital leases. And another important point to note in mind is that goodwill is recorded on the books of the acquiring firm, not on the books of the acquired firm. There's no goodwill on the books of the acquired firm based on the merger and acquisition or consolidation activities. And so we talk about goodwill, we say that goodwill is the excess of the sum of the fair value of the consideration transferred, the fair value of any non-controlling interest in the acquiree, and the fair value of any previously held interest in the acquiree over the net assets acquired. And so essentially what it's saying is what did we give up to buy this firm, and how much are we getting in return for what we gave up, and the difference between those two becomes goodwill. And when we think of goodwill, we really oftentimes may think about it of that's what we're paying a premium for an organization for in order to get perhaps its manufacturing technology, perhaps its intellectual capital or human capital, perhaps its market share, perhaps its market preference by its customers. And so that's what stands behind this idea of goodwill. And this idea of contingent consideration is, so suppose we buy an organization and we give up a certain amount of, we'll just say cash for now, in return for the assets, but giving up, we hold back or we put in escrow a portion of that cash and make it contingent on something happening. So perhaps we have some large outstanding receivables that we don't really know the collectability of. And so we might reserve a part of what we pay for the organization in order to cover those receivables in case they aren't paid. Or perhaps we buy the company contingent on receiving a large contract in the future. That's the decision process is well underway. And so releasing out of escrow the remaining amount of the proceeds for the company are contingent on that contract being awarded to the company. And so that's this idea of contingent consideration. It's just consideration withheld to the previous owners contingent on something happening. So the fair value contingent considerations is determined or estimated at the acquisition date and is included along with the other consideration given as part of the combination. Estimated contingencies are revalued to fair value at each subsequent reporting date, so that and sometimes these periods of time are very far out into the future, and so if something that it's contingent on happens, right, so it occurs, then we need to revalue the amount of that contingent consideration. So this is an example where Pitt acquires the net assets of SAD Company in a combination consummated on 12/27/2011. And we're given here the assets and liability of SAD Company on this date at their book values, and we also see what the fair values are. And so here we see we get cash that has a book value of $100. and these are in thousands. And the fair value with cash is cash. So the book value and the fair value are going to be the same. We have net receivables, which has a book value of $300,000, but they have a fair value of $280,000. So perhaps we're concerned about a particular past overdue receivable. So we're recognizing that we're paying we're going to be receiving the fair value of net receivables at an amount less than what the book value is. The flip side is on inventory in that, well, the book value of inventory is at $400,000, where the fair value is estimated to be $500,000. And so we go on down, we see total assets with a book value of $200,000 and they have or $2 million. They have a fair value of $2.8 million. We see total liabilities with a book value of $500,000 and a fair value of $480,000 to get us to net assets that have book values of $1.5 million versus a fair value of $2.4 million. So assume that Pitt pays $800,000 cash and issues 100,000 shares of Pitt Corporation $10 common stock with a market value of $20 per share for the net assets of SAD Company. So total consideration at fair value, if we add up all those components, is the $800,000 plus the 100,000 shares valued at the $20 per share market value, or $2.8 million. So we can see that there was, in our previous slide, we saw that the fair value of the net assets acquired were $2.4 million. We paid $2.8 million, and so the difference between those two, or $400,000, is what becomes goodwill. And these are the entries that we would book to record the acquisition of the net assets. A debit to the investment in SAD Company, which is an increase in our assets. A credit with respect to cash because we spent $800,000 in cash, which reduces cash. A credit with respect to common stock for the $1 million, which were the number of shares we issued at $10 par value. And then a credit to additional paid in capital, which is another increase in shareholders' equity of $1 million due to the difference between the par value and the market value of the stock that was issued. The entry to record SAD's assets directly on Pitt's books. So this is what we would enter on Pitt's books to literally transfer the assets. And you can go through this and you'll see that we have an increase in cash, which is an increase of assets, so that's the plus A, an increase in the net receivables. And remember, the net receivables now are increased based on the fair value, not the book value. And we see the same thing happening with inventories. They were based on the fair value of $500, not the book balance of $400,000. And we see that all the way through where we're booking the fair value. We're just simply increasing the asset or liabilities accounts of Pitt Company. We then credit the investment account in SAD because we've essentially moved those assets over, and we've taken that investment account that we previously booked an entry to, and we've eliminated that balance by spreading it across the various asset and liability accounts that were acquired, with the difference being goodwill of $400,000, which is again a debit to that asset account, goodwill. And so this is an example of this idea of a bargain purchase where Pitt Corporation issues 880,000 shares of $10 par common stock with a market value of $20 per share. And it also gives a 10% 5-year note payable for $400,000 for the net assets of SAD Company. So it's a slightly different financing arrangement. And what we see is the fair value, again, is the net assets acquired of $2.4 million. The total consideration that we've given, the fair value of that, is the sum of the 80,000 shares at the $20 per share market value plus a $400,000 notes payable, which essentially equates to combined a $2 million consideration. And so you can see that we've given $2 million up in this case in exchange for fair market value assets of $2.4 million, and we have a gain, which is again, we refer to that as this gain from bargain purchase. We're paying less for the assets, for the fair value of the assets and liabilities assumed than what we're giving up. And so under that scenario, we book on Pitt's side an investment in SAD company, which is an increase in assets of $2 million. We issue a notes payable, so it's going to be a credit to the liability, notes payable for $400,000. And again, we issue the same entries to the common stock of $80,000 plus $10 at $10 par value, so it's an increase to shareholders' equity. And then because the market value of 20 created a $10 delta between the par value and the market value, we have an additional $10 per share of additional paid in capital at 80,000 shares, which is also a credit. Then we record the entry book on Pitt's books the assets that we bought. And so here you can see it's essentially the same entry in that we're increasing all of Pitt's asset accounts for the fair value of the assets acquired. We're increasing Pitt's liability accounts for the fair value of the liabilities assumed. We eliminate the investment in SAD company because we're spreading those that previously booked value between various detail accounts, and then we recognize a gain from the bargain purchase option, and that's in the current year. So that's going to show up on the current year income statement, which, because it's would flow through the income statement, ultimately at the end of the year gets transferred to shareholders' equity. So this is just showing the difference between where we had a bargain purchase option, which we just talked about, or where we had goodwill, and how those two are separately or differently recorded. And so now we just want to talk about a few other issues that touch on our business combinations topics, such as impairments, disclosures, and then the Sarbanes-Oxley Act. So there are some good controversies around goodwill. We talk about capitalized goodwill, which is a purchase price not assigned to identifiable assets and liabilities. And we know that there are these it comes as a result, it's created as a result of getting to fair value of assets that are identified as part of the purchase, and the fair value of liabilities that are assumed as a part of the purchases. And so errors in valuing these assets and liabilities affect the amount of goodwill recorded. So historically, goodwill in most industrialized companies was capitalized and amortized. So what that means is that generally it used to be that we would capitalize goodwill, so we would book a debit to a goodwill account, and then we would amortize it over 20 years or more. Now we don't do that amortization anymore, and so we can see that our current standards, like GAAP, say that we still capitalize goodwill, but we don't amortize it. We test it for impairment. And impairment is a big word, an important word that we need to make sure we understand. And so impairment essentially says that we no longer have the same value. Something has happened in our operations that has impacted the value of the goodwill that was originally recorded. And so we conduct these impairment tests, which are essentially a two-step process where in step one we compare the unit's net book value to its fair value to determine has there been a loss in value, and if there has, we determine the implied value of the goodwill in the same manner used to originally record the goodwill, and then compare that to the goodwill in the books. If we find that the goodwill has been impaired, or that the implied fair value is less than the carrying value of the goodwill, we will record a loss. We should do our goodwill testing for impairment at least annually, and it may be that because of some of these significant adverse changes in business, we need to test that more frequently. So if there's an adverse action by a regulator, unanticipated competition, or a loss of key personnel, all of which are items that, if you can think about, if these didn't happen, right, they're items that may have contributed to our willingness to pay a premium for a company. So perhaps we had one of our key personnel who was the only one who knew a particular process or had such specialized knowledge in a particular area that we were much more competitive in that area, and we lost that personnel. Or a new competitor entered the field that didn't exist 5 years ago when we bought the business. So suddenly it's something that makes us our ability to be as profitable as we had been or expected to be when we bought the organization. It's impacted that. And so these are, if you can think about it in that way, these are items that might reduce the value or impair the goodwill in the books. So impairment or expected disposals of reporting unit or a part of one or significant long-lived asset groups or subsidiary are all things, activities that cause us to may cause us to have to test goodwill more frequently. Then we talked just a little bit about the types of disclosures. So business combination disclosures include but aren't limited to the reasons for disclosures, the nature and amount of the consideration given, the allocation of purchase price among assets and liabilities, pro forma results of operations. So as a result of this, how do we expect that this particular merger, acquisition, consolidation is going to impact our operations moving forward? And then this whole idea of either reporting goodwill or reporting a gain from the bargain purchase option, bargain purchase are items that we may have to disclose as a part of the transaction. We also may be required to report certain disclosures about intangible assets, and specifically we need these disclosures in the fiscal period when intangibles are required, annually for each period presented, and in the fiscal period that includes an impairment. We also note that disclosures are needed for intangibles which are not amortized, intangibles which are amortized, research and development acquired, and intangibles with renewal or extension terms. And again, when we talk about intangibles, we're talking about items like patents or copyrights, this idea of research and development that may be sitting on our books as an asset according to generally accepted accounting principles. And so then we talk a little bit about the Sarbanes-Oxley Act of 2002, which was really developed as a congressional act, and it was meant to help protect consumers and investors. And it came about as a result of the Enron and MCI and Tyco abuses by management and outright criminal actions that went unrecorded and resulted in multi-billions of losses to shareholders and investors. And so Sarbanes-Oxley created this Public Company Accounting Oversight Board, which then moved forward to create certain rules and regulations requiring greater independence of auditors and clients, independence of corporate boards, independent audit firms, and audits of internal controls, increased disclosure of off-balance sheet arrangements and obligations, particularly those related to intercompany transactions, and then more types of disclosures on Form 8K, which are the forms that companies have to acquire with the Securities and Exchange Commission. And then SEC, or Securities and Exchange Commission, enforces the Sarbanes-Oxley Act and the rules of the PCAOB, and companies that don't follow these rules and don't adhere to the SOX requirements can be barred from being publicly traded on public stock exchanges. So it's very important that companies adhere to Sarbanes-Oxley, and that where Sarbanes-Oxley requires the different types of disclosures around acquisitions, mergers, combinations that we just talked about, that they adhere to those.